Hi again. Welcome to Chapter 2, Apply What You Know. We have some few basic examples in this exercise. First one is kind of a case study, and let's go with it. So first, let's read it. What would you like to drink with that? Asked the counter person to the Tamara Hendricks. Tamara was in Metropolitan Airport, and because the time between her connecting flight was short, she had stopped in a busy deli outlet for a pre-wrap sandwich that could be purchased and eaten quickly. Give me a small bottle of water, the 12 ounce, not the 20, replied Tamara. This looks great, and I am starved, told Tamara happily as she left the busy counter. As the newly appointed district manager for Copy Plus Business Centers, there was a lot of travel involved in her position, but she loved her job. How much was that? Asked Jerome, as Tamara joined him at the stand-up counter that served as Delhi's small designated dining area. Jerome had been with the Copy Plus for over 10 years and also held district manager's title. Jerome was traveling with Tamara to Copy Plus regional sales meeting, had also ordered a sandwich and drink from the same vendor, and was now staring intently at the tray she was carrying. My sub? Asked Tamara. No, replied Jerome. The water. 350, said Tamara, the same as your soda. That's crazy. There is a drinking fountain right over there, he said, pointing a water fountain located between the entrance to the men's and ladies' restroom just across the area in which they were standing. Why would you ever pay good money for something you can get free? I mean, besides the prices at the airport, you know how crazy they can get. Let's look at these questions. As usual, if you can, please stop the video here, look at the questions, try to come up with your own answers, then come back and let's talk about it. Now, hold on just a second. Okay. Now, first thing, what did Tamara buy for a $3.50? At the time of purchase, do you believe she was pleased with her transaction? Now, why you want to pay that much of money? Of course, first, you are thirsty, right? But why you are not going to get from fountain? I mean, convenience, portability, freshness, pretty, perhaps even status, like you are holding a, I mean, this is very common right now, but it used to be having a Starbucks on hand, like it used to be like showing up, showing off in a sense, but now it's very common. But none of which, like all this freshness, portability, status, etc., could be delivered by the water fountain, right? So if you look at from that perspective, yes, she find value in that transaction and she was pleased. But what about Jerome, right? To Jerome is ridiculous. I mean, why you want to pay if you can get free? That doesn't make sense to Jerome. Now, let's look at the second question. Do you think Jerome would be more likely to value and buy bottled water from this pizza vendor if its price were reduced by 10% or if it was reduced by 50%? Now, if you think about the 10% first, is 10% of 350 is 35 cents. It's like 350 to 315. Most likely, it's not going to change Jerome's mind about the value of bottled water. But if it's the 50%, that might be possible. That at the point that Jerome would feel the convenience of the bottle itself would have value. Do you remember the earlier, not earlier, but the first video, perceived value minus price? So if your price dropped at a certain point and perceived value might exceed, then that person is going to buy. So for $3.50, Tamara's expectation or Tamara's the perceived value is much higher considering the $3.50, but Jerome's perceived value is much lower. That we don't know exact amount, but we are just making assumptions here. Let's look at the last question. The Jerome is 58 years old and Tamara is 28. Do you believe a person's chronicle age or any other demographic characteristic can affect how a buyer views as a seller's value proposition? what are some specific examples from your own life experience or those of your customers that support your position? Now, bottle water is perhaps a classic example, right? How age impacts buyer behavior, because older buyers like Jerome simply have a bigger problem paying that has always been free, in this case, water, than do younger buyers with a different kind of life history. Now, we are just giving an example of that buyer demographics that affect purchasing decision will vary. It could be many things related to their income level, their age, their whatever you can think of. What I want you to do is think about it. How do the buying habits of your parents or grandparents vary from your own when you go to somewhere? I want you to be observant of that. Now, the idea here is why we are doing this exercises. Effective revenue managers can identify buyer characteristics that help better predict customers' views of value, right? They can use that information to gauge the willingness to buy levels. So overall, the idea behind this exercise, once again, one buyer's view of value for price paid can be very different from the others. Okay, so that's the important part, right? There are different people with different perception value, different approaches to different products. So what I want you to focus on is actually we're gonna discuss in the future chapters is called differential pricing strategies, which is basically focus on this kind of approach. Now let's look at the second one. Oh, this one is I wanted to give you some interactive example of how is the break-even analysis works. This built by my very good friend and mentor Zivi Schwartz. The idea here is this is for the hotel. Let's give you an example here. Like there is a 3 inputs you can change: your average daily rate, basically your room price, variable costs, you know what your variable cost is going to be about, and your fixed costs. Okay, so you give some certain values. In this case, you can change to any value, but let's make up something. It doesn't matter. Okay, if your fixed cost is $785, and if your variable cost is $30, and assuming that your average daily rate is $66, you need to get at least 22 rooms of revenue of $1,439 to able to start to make money, which is this point over here. If fixed cost is usually fixed, but let's assume, let's say your ADR increased. See, now 66 to 92, now you need to sell only 13 rooms. So if you sell more room, is going to more than 13 rooms, it's going to start to make a profit. This is just to give you an example of the of course, if you go too much, it's gonna mess up. But the idea here is your price, your variable cost, and your fixed cost is changes how many rooms you need to solve, minimum revenue you need to generate in order to be successful and in your business. I just want to show you some dynamic approach. Okay, let's see what it says. Laura Makowski operates a restaurant serving Latin American cuisine. Laura is preparing a profit forecast for the next year. Laura's fixed costs are $350 and her variable costs are 65%. Okay, let's answer some questions. Now, what will Laura, once again, if you can, please stop here, do it this yourself and come back here. Okay, I'm assuming that you did some of the calculations. Let's look at the first one. So basically, she did different forecasting for the next year, and she wants to see if she's going to be able to make money under that circumstances. The first one is 900,000, right? So if you look at this, you will see here because of the variable cost is 65%, you multiply 900,000 with 0.65, which gives you 585,000. Fixed costs are same. Total cost is basically adding this two, right? Sum of this. And this one is going to be revenue minus total cost. So to answer the first question, actually she's gonna lose money. So that, by the way, if you don't know, in the Excel, if it's in the parentheses, that means it's negative. Now, let's make it our job a little bit simpler. If you recall from the first video, if you have the same level of calculation, which is basically all this area is the variable cost calculations, we can hold the bottom line and put it all the way here and just check quickly. See, calculate this by 0.65. These are the variable cost. And 350 is the same for all anyway, so there is no calculations. Once again, we can do the same thing here. And also we can do the same thing here. Now, what is Laura's forecasted break-even point, which is this one, right? So she forecasted 1 million, total cost is going to be 1 million. So basically that's the break-even. So she needs to make more than 1 million. And the next question is the for the 1,200,000, which is basically she's gonna start to make money, $70,000. So thank you.